have the four main sloping schematics. And I'll zoom in on each one and talk about them one at a time. We have an upward sloping accumulation, right? So instead of it going sideways and giving you the nice spring that you want and all the different terms that we've talked about, this is where it accumulates in an upwards manner. You can characterize this by seeing the selling climax, AR, and ST forming the basis of a sloping channel. So when you see price moving upwards in a channel, generally there'll be a trend line on top, trend line on bottom. You'll see a few things. You'll have an upthrust action, which takes out the AR high and creates the upper channel. You then have the lower channel by the SC and the ST. Price then consolidates and goes round, but goes in an upwards manner, takes out the high again, sells off one more time. Here is where you have your spring. So your spring doesn't take out the ultimate low because price is trending upwards, but it does fake out below the trend line of SC and ST. Important not to trade this. You don't buy here. It gets back inside. You get a test. You move into phase D, and that's when you start to consider longs. But even still, you need to be mindful because this could also still be distribution, as I'll talk about in a moment, which is why you wait for the jump across the creek, the back up to the edge of the creek, and then you trade on show of strength as a breakout because this was an upward sloping accumulation. So that's how it looks. You've got all your elements of Wyckoff within that, and that is one way you can trade an accumulation on the upside. Let's look at downside accumulation. Very common as well. Sometimes price will come down and it will, instead of forming a nice horizontal like we want to see, it will continue to trend down and it will look bearish. So let's dig into it and understand why this is in fact not bearish. You have a selling climax, automatic rally as usual. You then have your secondary test, which takes out that low, and then it causes a rally to the other side, which takes out the high or creates an equal high. This is your upthrust action. And across the AR, you can draw a line, and across the ST and ST, you can draw a line. SC and ST, you draw a line, right? The UA should deviate above this line, and there should be a test, ideally, before or after. Well, there'll be a high before it and a test after it, that confirms some type of channel. The main thing you want to look for here is a channel, and so instead of a horizontal level, where you're looking for upthrusts and springs, you're looking at a channel, and you're trying to spot the fake outs within there. Trends down, phase B, down to the range low, takes out all of that, goes into spring. Now, important at this point, if you're looking at this with no lines and no markings on the chart, this is going to look and feel extremely bearish because it's well below the selling climax, it's well below the ST, and that's the point. That's what makes this one effective, which is why you need to look at your sloping channel. If it's go down below the sloping channel, recovers and tests back off it, then when you push towards range high, you can say it's probably in phase D. And again, on the breakout, you want to be looking for strength and trading it in the retest back up to the edge of the creek. So that's accumulation done. You now know horizontal accumulation and sloping accumulation, both upside and downside. Let's talk about distribution. This one, very common, and there's a couple of nuances you need to spot in here. So this happens a lot in crypto where price looks like it's bullish. It looks like it's trending up, and then all of a sudden it just weakens and drops off. So this one catches more traders out than the typical horizontal distribution because the horizontal one's easier to spot. So how do you spot this one? Same principle, your buying climax, your automatic reaction, your ST, and then you have a minor show of weakness. This is important. Now, this doesn't become clear until phase C, and that's the point. Remember, we don't trade in phase B, but after price forms through here and goes up for a UTAD, so once it makes this high and comes back inside, you should have a line drawn across your buying climax and ST for a nice channel. If we deviated that channel and fell back inside, then look below. Your AR line should join perfectly across, touching both of these if it's bullish. The fact that it goes across and we have two deviations below that channel line, they are considered minor shows of weakness. That is your little clue from the market that this is looking different, all right? Explain. The upward sloping accumulation looks like this, yes? You touch it, you touch it, you touch it. You only then, once do you spring it later in the schematic, later in the accumulation. So the touches are important. If it holds a channel on the way up, that's likely accumulation. If by the time you get to phase C and you're looking at your channel and it looks like this, where there's a lot of grabs below, minor shows of weakness, that gives you high probability distribution. Same again, of course. You don't trade it until it starts to break, as it's a momentum play. And when you go into phase D and you lose the channel and you get your bounce, your last point of supply, your major show of weakness, that's where you want to start actioning trades. Finally, we have a downward sloping distribution. This one has your buying climax, your AR, your secondary test as normal, and then we go straight into a minor show of weakness. We then go for an upthrust, and then we have an aggressive UTAD. This is characteristic of a late stage rally, where you have a strong push up, doesn't take out the highs, a pretty strong sell off, and then a really aggressive push that rejects quite hard. You then have your test. Once you can draw that channel line across, if you see deviations above the channel falling back inside and you look below and you had your minor show of weakness, once this trend through the range starts, it's high probability distribution. This is the most aggressive distribution there is. So you really want to keep an eye and remember the lesson from before about impulse and correction. If it impulses down hard and corrects slowly, and it impulses again, you're very, very likely in an aggressive distribution. This is the one that doesn't wait around. This is the one that has very little bounces, very shallow, and tends to just rip through the range. The reason being is because it's quite clearly weak from the start. This is quite clearly a weakening trend. This doesn't look in any way like it's going to go up. And then so the grabs are almost just a last ditch attempt to get some liquidity by smart money. But once it's over, this one's over pretty quick. So that's it. They are your 4 sloping schematics. We've also covered the horizontal schematics. And up to this point, we've talked about reversal structures. So all of the structures I've showed you have been showing how it goes from an uptrend to range to downtrend or vice versa. But in the next lesson, I'm going to go through the Wyckoff structures that don't lead to reversal, but instead lead to continuation of the trend, also known as reaccumulation and redistribution. So we'll go into those right now.